Hey traders, this is Blake Morrow with Trader Summit. And with me, I have Eric Basmajian from EPB Macro Research. It's good to see you, Eric. It's been a long time.
It's good to see you, Blake. I think the last time we spoke was before the Russia invasion of Ukraine. So a lot has changed since then.
The whole world has changed
Seriously.
dramatically. And so that means that we're, chock full of stuff to talk about. And since the dynamics and the markets have changed so much, what is what's your just a brief outlook of the environment right now? And then we're going to dive into some of the key topics that you want to discuss.
Sure. So the way that I see things unfolding now is that prior to the Russia invasion of Ukraine, the U.S. and global economy was already in a slowdown. Yeah. We were slowing from an extremely elevated level, but we were gradually coming down month by month by month. We had the Delta variant, which people thought was the cause of the slowdown, that came and went. Then we had the Omicron variant that came and went. And then we sort of started to realize that, hey, you know what? Growth is actually just start kind of coming down a little bit. Sure. Then the Russia invaded Ukraine, and that was a negative shock. It caused oil prices to rise, food prices to rise, and it caused the Federal Reserve to reassess their monetary tightening plans. As late as February 2022, which seems kind of crazy given where we are now, inflation expectations were below the long-term average, like five-year forward. So long-term inflation expectations were about 1.9%, below the Fed's target. And the market was only pricing that the terminal Fed funds rate was going to be 1.5%. In other words, not that many rate hikes were needed in order to combat inflation, according to the market in February. Then Russia invaded, oil prices spiked, food prices spiked, and it kind of gave a major second wind to this inflation story. And here we are, now we're pricing a 3.5% Fed funds rate by the end of the year or beginning of next year. So a 200 basis point change in where the market thinks that the Fed funds rate is going to go. And of course, if interest rates are going to rise that rapidly, that's not going to help the slowdown that was already in play. That's going to amplify it. So now we've shifted from a slowdown to a slowdown plus a shock, which has now created a significant recession risk. And I think that's going to be the story over the next 6 to 8 months.
So a lot of people are looking at, recession risk they're looking at 2023, but do you think it could actually be moved forward towards the end of maybe second half of 2022? Is that correct?
Yeah, exactly. So I think that the market has fully accepted the fact that the economy is slowing, but I think that most people believe we're still slowing to trend or something like that, a benign slowdown. And if we have a recession, maybe it's just going to be a quote unquote technical recession or a garden variety recession. But I think that there's the probability for something a little bit more sharp over the next 6 to 8 months. And I do believe that the recession risk is actually in 2022, not 2023. And I think that the market may be mispricing some of that risk. And what I mean by that is credit spreads are still relatively tight. We've started over the last couple of weeks to see them leak wider. But the investment grade, like triple B corporate spreads, are still relatively tight, given what I believe is a significant recession risk. And we still don't see the yield curve fully inverting, although it has flattened quite significantly. So there are some signs that the market sees a slowdown, but it doesn't fully accept the fact that recession risk may be actually right in front of us rather than down the road.
So how does that look let's talk in terms of a couple of different points. So let's start off with employment. How are you seeing employment and what's its role in a potential recession, and how do you see it going into the second half of this year?
Yeah, that's a great question. I'm glad you asked that. I have a chart here that I'll pull up and show as I talk through this.
Sure thing.
Let me know if you could see this chart here. This is So these are the four corners of the economy. This is what the NBER looks at when they actually judge business cycles. Most people think that a recession is 2 consecutive quarters of negative GDP. That's a rule of thumb that was made popular by a newspaper columnist. It generally works, but it's not the actual definition. The actual definition of a recession is a widespread contraction spread across the economy, impacting production, payrolls, consumption, and earnings. In other words, for it to be a recession, it has to hit all corners of the economy. You can't just have a slowdown in consumption, but strong employment, or a slowdown in production, but strong earnings. It has to be widespread across all areas of the economy. So these are the four corners. And what we see is a massive, massive slowdown in the growth rate of real retail sales, which would be consumption, and real aggregate earnings, which would be income. So we have a negative growth rate for income, and we have basically a negative growth rate on real consumption. So if you look at those two variables, you'd say, well, that's pretty much recessionary. That's negative growth. But we have production numbers that are still pretty strong, 7% annualized growth rate on production. And we have employment that's still growing at 4% annualized. Now, the employment numbers are edging lower. There's been a deceleration. But in order for there to be a technical recession, there needs to be a significant slowdown in all of these areas. And we haven't seen the slowdown come through employment quite yet. Now, is that unusual? Not really, because as we all know, employment is a lagging economic indicator, right? It doesn't really precede slowdowns. It reacts last in the economic sequence. So if we look at the monthly changes, 390 is still a very high number, which is why we're not in a recession now, unless these get totally revised away. We've seen a deceleration in the monthly additions. So we were at 600 on average, and we've cooled significantly. So it's following the cycle lower, but it's following it in its traditional lagging fashion. So I think that over the next couple of months, we're going to see the slowdown most concentrated still in the housing sector. And then it's going to bleed through to these new orders and these PMIs that we've seen take a step function lower. And I think that by the time we get to October, November, December is when the employment numbers in the sequence of economic events is most likely to see a step function lower. And at that point, we'll know whether we're in a recession in 2022 or 2023. It's going to be, do payrolls sort of continue to stay high into next year, or do they come down quickly? And my view is that they're going to come down quickly around the end of Q3, beginning of Q4, based on the sequence that I track. So
we're not in any like immediate risk of like next week, as we're filming the end of June here, going into the end of next week, where we have our June payrolls numbers. You're not looking for an extreme drop off at that point.
No, I'm not. I would be surprised by that. But what we have to understand is when the economy is cycling down, which it is, this is the composite of those four indicators that I showed. This is, just blended them together. Yeah. So the economy is clearly grinding lower. So I wouldn't expect like a negative payrolls number or some wide miss, but you always have to have your bias to the downside since we are in a slowdown. The momentum is heading lower. So I think that if you are going to have a surprises to the downside are more likely. The best evidence of that would be like the flash PMI readings that came out earlier in the week. We saw Europe numbers plunge. The US number was expected to come in at like 56. It came in at 52, way lower than people expected. So as we're in this slowdown, all surprises are going to be to the downside. I don't think we're in a recession right now, given the fact that the payrolls numbers are still too high and the aggregate growth rate is still in the 2% range. But one point I want to make is that this index here is basically the same index as the one I just showed. The only difference is that this index here contains retail sales, which comes out in the middle of the month. And this index here contains real personal consumption, which comes out at the end of the month. So what I'm saying here is that this index is updated as of May. This index is updated as of April. This will be updated at the end of the month. And the reason I'm showing that is because you see how we have this slowdown that was building since the spring of 2021, and then the growth rate has sort of flattened out since September. That was actually revised away when we look at the new numbers. So we have to also be mindful of revisions that come into the data. So while I can say that we're not in a recession right now, and I can say that with confidence as the data stands today, these numbers are constantly revised. There's benchmark revisions that happen a year later. So it is possible that we can look back on this period a year from now and see these numbers revised meaningfully lower. And we'll say, oh, maybe we actually were in a recession at that time. With the data that we have in front of us today, we're not in a recession, but that's subject to change. I think the momentum is lower, and the risk is that we do slip into a recession by the end of this year.
And what some of the data that you say is not included there is retail sales. And how do you see the consumer faring through this, possible recessionary period?
Yeah, the consumer is really getting hit from all angles. So I don't think that this is going to be kind to consumers. One of the secrets of cyclical analysis is some of your lagging economic indicators can actually be your earliest leading indicators. Because if the economy moves in a cycle, The most lagging piece is actually, in a way, your most leading piece, right? Yeah. So we know inflation is a lagging economic indicator. Growth tends to move lower and inflation peaks sometimes during or after the recession. But if we invert that and that becomes our earliest leading indicators, the sharper the rise in inflation, the more sort of painful it's going to be, or the harder it is for the consumer to recover. So what we have now is the consumer that's dealing with a decline in asset prices, because stock prices, bond prices, and in my opinion, real estate prices are going to start coming down. So the consumer has a negative shock from household wealth. They have a negative shock from a massive increase in interest rates. Mortgage rates would be the most proximate impact on the household sector. And then they have just higher inflation broadly in the form of fuel. Right. So we have negative asset prices, we have an interest rate shock, and we have an inflation shock. All three of those are negative shocks that are impacting the consumer. And I think that employment is going to suffer as well, which is basically going to put the consumer in a really difficult position.
You know, Eric, I didn't go back and review our last conversation specifically going through, each and every point. But what I do remember and recall is that the Fed, your warning at that point was the Fed is about ready to embark on, on raising rates in a slowing environment, and they're going to make a misstep. But here we are again. Fast forward 4 months later, and because of your travels and vacations, we've had a hard time connecting, and I'm so glad we get to talk now. However, look at the Fed now. How big of a mistake are they making right now, and where do you think that what's going to stop the Fed from raising rates or actually changing expectations moving forward? Because right now, as you pointed out, the Fed or the market is expecting another 75 basis point rate hike in the next meeting. So when does that change? When does the Fed stop and reverse course?
So they are tightening into a slowdown, and the result has been anywhere between a 20 and 30% decline in asset prices, depending on the index that you pick. I can't say that they've necessarily made a policy mistake, because post Russia, there was a secondary spike in inflation that they had no choice but to address. But the repercussions of that have been a 20, 30% decline in asset prices. The reason I believe that they're making a mistake here, and I think that this is ultimately going to lead to a problem 6 to 12 months down the road, is because interest rates are a leading economic indicator, right? Or I should say it more specifically, the rate of change in interest rates is a leading economic indicator. So if you have a massive rise in interest rates today, you could be fairly confident that 6 to 12 months down the road, that's going to slow economic growth. Or conversely, if interest rates decline sharply today, that's going to have a positive impact on economic growth in the future. That's why people say that monetary policy has long and variable lags. If the Fed cuts rates today, it takes about a year for that to kind of filter through the economy. Or if they raise rates, it takes about a year for that to filter through the economy. So what this chart shows is a composite basket of interest rates. It's mortgage rates, it's corporate rates, and it's treasury rates. So this kind of impacts everybody. It's impacting the household sector, the non-financial corporate sector, and the government sector. And this is graphed on an 18-month rate of change, and it's inverted. So when the line is moving lower, that means interest rates are rising. And when the line is moving higher, that means interest rates are falling.
Sure.
It's a long-winded explanation, but this is an extremely important chart. In 1999, again, this is a leading indicator. So over a year before the recession, we had a 200 basis point increase in interest rates across the economy. At that time, aggregate debt in the system was about 270% of GDP. It ended up leading to a recession that necessitated a large decline in interest rates. If we go to the 2006 period, about a year and a half before the big blow up in the great financial crisis, interest rates had increased only 150 basis points with 330% debt to GDP. And then if we go to 2018, all it took was 129 basis points of interest rate increases across the economy for there to be a recession risk and cause the Fed to pivot. And the reason that the increase in interest rates that necessitates a recession is getting lower is because the debt levels are getting higher, right? So if you have higher debt, it takes less of a spike in interest rates.
Yeah.
So now we have 370% debt to GDP, higher than any of these other periods, but we have a 300 basis point increase in interest rates. This has a lagged effect. So the Fed has no idea when or how much this is going to impact growth. All we know is that 6 to 12 months down the road, there's going to be an impact, and it's not going to be a positive impact. It's going to slow activity. That's what they want, but they don't exactly know when or where to stop, because they can't raise rates today and know exactly what's going to happen 12 months in the future. They kind of have to wait and to see when it happens. So long story short here is that we have a very, very massive debt load across the public and private sector. And we also have a record interest rate shock that is going to have to interact with. And the probability that this ends very mildly, in my view, is not very high.
So, looking at this chart and being a trader as I am, and, and many viewers that are watching this particular video, we're all traders, and we try to anticipate what price movement's going to do based on historical price charts and a macro backdrop. If you can just grab a gray shade and I think we could shade in like a big block behind right? Is that what you're thinking right now?
Yeah. So, I mean, it seems like that's the likely scenario. Now, I never make a forecast based on just one indicator. So if you look at this, you'd say, wow, that really looks like there's going to be a recession. And I would probably tend to agree, but I don't present this chart as a single factor. The way that this works in my process is that this is a long leading indicator. Yeah. So we have a tightening of monetary policy. We're seeing that impact flow through to interest rates, which is how it's designed to work. And then what happens next? The most sensitive sector to interest rates is housing. So we've started to see a lot of headlines about the housing market slow down, layoffs in the housing sector, mortgage lender layoffs, right? So that's the next step in the sequence. And you've probably heard that housing is also a leading economic indicator. So now we've seen the monetary policy get tight. We've seen the interest rates rise. We've seen the housing sector start to slow down. Now, over the next, I would say, 3 to 6 months, we're going to see this slowdown bleed through to some of the indicators that consensus follows a little bit more closely. Things like the ISM PMI, consumption, industrial production. We're seeing inventories rise at major retailers. And the market tends to react to that part of the sequence. So I think that your biggest market reaction to what I believe is going to be a recession risk is going to be in the next 3 to 6 months based on this sequence, since that we're already seeing the slowdown hit the housing sector. So as a trader, the way that I would be taking this information is that over the next 3 to 6 months, we may have a second leg of this bear market. And that second leg will be the one that's characterized by the market coming to terms with the fact that this may end in recession. This first leg has been mostly associated with just a plain rise in interest rates and maybe a valuation compression, clearing the froth out of the market just based on higher rates. Yeah. We haven't really seen credit spreads widen that aggressively. And we haven't seen earnings expectations come down. That's the big key. So this next leg lower over the next 3 to 6 months, if this data does in fact flow through, we're going to see earnings come down. And that's when we're going to see the next leg, I believe, of this bear market.
Yeah, and a lot of people have that I've spoken with and had discussions with as of late said that's like the next shoe to drop is when earning expectations start to come down. And I don't want to make light of this situation because it is obviously we're facing the potential risk of a recession squarely in the face right now. But let me ask you this, Eric, based in your view, what could happen that would avert a recessionary type of environment moving forward? What would you have to see?
That's a great question. It does seem like most people have come to grips with the fact that recession's a risk, at least in the narrative or consensus, but it hasn't actually leaked into market pricing. But what I think the problem here is that when you have really, really high levels of debt, increases in interest rates are really toxic, right? Because debt needs to be refinanced, and you're going to have to refinance all that debt into higher rates, and it's going to really damage economic growth and earnings and a lot of financial statements of companies. So there's a couple of things that can sort of give you an idea of the severity of a recession or slowdown. And one is, how much do interest rates rise? And on this chart, we've already had a really significant increase, which is problematic. And then number two is how long do they stay up? So if this line snapped back and interest rates got cut immediately, and it was just a sort of quick flash, the market may be able to avoid a recession because interest rates didn't stay up long enough for enough people to sort of refinance into that new level of debt. So I believe that if we're going to have something that resembles a soft landing or a mild situation, we're going to have to see these interest rates sort of back off really quickly. We're going to need to see the mortgage rate come down. We're going to need to see corporate rates come down. And all of that's going to be basically predicated on whether like the 10-year treasury comes down.
Yeah.
So to the extent that these rates do not come down, or in fact, they continue to go higher and these rates go up hard and stay up long, that's going to increase the probability of a more severe type recession. If these rates come down really quickly and really hard, that's going to ease the probability of a recession. But whenever you have a really, really high debt level and then you have a rise in rates, that's generally not a good combination. So I think that the interest rate story is really what's going to determine that. And the Fed is really in control of that. So it's going to be basically predicated on how long and how hard they tighten.
And everybody's waiting around for the quote unquote Fed put to come around. But, I'm going to take a step back for a moment and, take us back to, let's just call it, 2020, 2021, post COVID, the Fed is engineered all of these acronyms and credit facilities. And, at that point in time, we were always thinking about the Fed, they talk tough, but they never did anything about it. And could we get that in reverse, where the Fed starts laying off some of this hawkish rhetoric, but in their actions, they continue to raise rates? And, we kind of get the inverse of what we had a couple of years back. Could you ever see that happening with the Fed?
Yeah. That's interesting. I think it's possible. And I do think that the market or market participants have been conditioned to expect the Fed pivot quicker than we may get at this time, because inflation was never an issue then. Now it is. But what I find really interesting is that the Fed, especially Jay Powell, more so than Yellen, is laser focused on the credit markets. A lot of people are like, if the S&P went down 20, 25%, they're going to pivot immediately. What's interesting is that we've gone down 25%, but as far as orderly declines have been, this has been just about as orderly as it could possibly be, right? So if the market went down another 10 to 15% in the way that it just did, we'd be down 30, 35%. I still don't think the Fed would pivot. What would get the Fed to pivot is the credit market starting to freak out, the credit market seizing up, liquidity really drying up. And we haven't quite seen that yet. This chart that I'm showing here is the triple B credit spreads, basically. And we had a major slowdown in 2012 that was on the back of the European crisis. It ended up not being a recession, but credit spreads widened out to about 300 basis points. In 2016, we had another quasi-recession. It wasn't a technical recession. Spreads went to about 300 basis points. In 2018, we had another slowdown. Credit spreads went over 200 basis points, but the Fed did a quick pivot there, and also no recession. We haven't even widened past 200 basis points yet, even though recession risk feels quite palpable. So I believe that credit spreads are in the next 3 to 6 months going to widen into this orange range, into the major slowdown range. And then if we do end up going into a recession, that's when credit spreads go, beyond 400 basis points. But the reason the Fed hasn't pivoted yet is because the credit markets are still very calm, and the credit markets are going to remain calm until recession is very obvious. And then I think we got to blow out in credit spreads. And that's when I think that there's going to be a Fed pivot, in my view, because a credit spreads of 400 basis points, it's going to be difficult for inflation to be sustained in that environment, because there's usually just so much downside chaos.
Yeah. Well, let's I guess it's going to be really interesting to see where we land in the months ahead. And I'm going to tell you this, Eric, right now, that I've missed our conversations. I'm so glad we got to reconnect now at probably one of the most important times of this current cycle. So as a trader, how do I follow your work normally on a daily basis?
Yeah. So I'm very active on Twitter. You can follow me on Twitter at EPB Research. Or I also publish a monthly note that covers these cyclical trends on my website, EPB Macro Research. I cover the current trend. I cover leading economic indicators about what to expect over the next 3 to 6 months, sort of what we described today. I put that out monthly, and that's available on my website, EPB Macro Research. And then also for free, I also publish my entire framework so people can get a deeper understanding of what I do on my website. It's totally free. I don't ask for your email or anything. I just try and put it out there as a way to help people understand the process that I go through, because it's a little bit different than most people. I'm heavily focused on these cyclical trends and leading indicators. So that's sort of all the resources and places you can find me.
Well, Eric, I want to say on behalf of the Trader Summit community, thank you for spending your time with us. I know it's valuable, and I enjoy it. I'm excited for us to be able to connect more often moving forward. So thanks.
Yeah, we'll do it a lot sooner the next time for sure.
All right, Eric. Have a great day.
Thank you, Blake. See ya.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.